it will be a very small video on the scope of FDD, as in like what is actually done in FDD rather than how it is done or why is it done. So basically the FDD process starts after you sign an LOA and the interested party is been selected by the sell side advisors and the target. Mostly in most of the cases, primarily related to the P and VC funds, FDD is being outsourced to the big fours and to firms even outside big fours for sure. But normally in case of strategic buyers have their own internal FDD team who underwrite the deals, same ways that happen in banks. So banks have their own credit team who underwrite the loans. The scope will vary from case to case, but in general the scope outlines the following areas. One, understanding, one reads the annual report, basically how the annual report is presented. So the financials are being presented, namely balance sheet, the income statement and the cash flows, and then there are notes to accounts, as in like what kind of policies are being followed by the company. So similarly, as in case of an annual report, a financial due diligence report is being prepared as well, but the objective of financial due diligence report is very different from the audited report. In case of financial due diligence report, if you look at reports from any of the big four, any of the consulting firms, the structure will vary completely depending on which firm is doing the financial diligence report. So P firm would basically be interested in knowing what is the current ownership structure of the target. By ownership structure I mean the primary holding company, which could be housing n number of subsidiaries. So what is the current ownership structure in the holding company in which the transactions will be held? Basically in that holding company, basically which is the top, shares are being bought and sold. So there could be a case of warrants outstanding, there could be a case of ESOPs outstanding, there could be a case of convertible preference shares. One has to know the terms by looking at the preference share agreements. Similar with respect to convertible debts, there could be a case of options outstanding as well, which the company could buy back. So basically what the PE firm would be interested in knowing is that what could be the dilutive ownership after all these derivative instruments are being converted. Most of the companies operate in more than one country, and in that cases, instead of preferring to open a branch of itself, they prefer to acquire companies and show them as subsidiaries of the holding company. So there would be n number of subsidiaries based on the number of country it operates, and in that companies as well, the ownership structure could be like the holding company could be holding majority portion, whereas there could be a case of minority interest as well, wherein external shareholders could be holding equity in those companies, and there could be a case of dilution in those companies as well. So whenever you'll be consolidating everything, your effective ownership in the holding company could vary as well, depending upon what are the dilutive shares in the subsidiaries. And secondly, it could be around the business model. What is the revenue model? These are the basic things. Basically this information you can easily get from the IMs. Primary reason for any client to appoint accounting firm as a financial due diligence advisor is to find out if there are any loopholes in the accounting policies being identified. And as per my limited knowledge, I have not come across any report wherein the FDD guys were able to find any misappropriation or inappropriate usage of accounting policies, because normally what I've seen is that they, so say for simple example, suppose December 31st is your closing. On the last day you pass 6 journal entries for sales, but your accounting policy for sales is whenever the goods are being shipped to the customers, you record a sale. But there could be a possibility like the sales are being recorded just on the basis of an invoice, although the goods are still in your warehouse. So that would mean an overstatement of sales, and that can't be identified by the financial due diligence guys, primarily because there is no vouching involved in FDD process. Basically it is entirely about analytical procedure. By deal metrics I mean, so the adjusted earnings and the net debt will pertain to the historical period itself, because in FDD the assumptions etc are not being questioned in the financial model, that is outside the scope of FDD. And how does one arrive at the adjusted earnings? By adjusted earnings I mean EBITDA. It is given that the valuation will be based on EBITDA in most of the cases. A reported EBITDA, that you will get, basically EBITDA not even mentioned in the annual report as well. In the audited financials, basically PBT is mentioned. So for EBITDA, basically just on the basis of the trial balance itself, you basically just have to in PBT you have to add back the depreciation and interest, so you will get the EBITDA. and that would be a reported EBITDA. A simple example, say an expense is non-recurring, that is, it is incurred only in one of the periods and it is not going to continue. So basically you will add back the expense to the reported EBITDA. So in that case your adjusted EBITDA will be more by the amount that you have added back. So that is basically, in a simplistic way, that is basically how you arrive at an adjusted EBITDA. Although for adjusted earnings a whole separate video can be made being adjusted debt. So again, to understand adjusted debt, I think why adjusted debt is important is the reason primarily being any company valuation is based on the enterprise value. By enterprise value I mean, in a simplistic way, the value of your equity plus cash minus debt. So, basically for net debt, for identifying debt items as well, so it is clearly most of the debt items will be identified from the balance sheet itself that is presented in the annual report. But however, there could be a few debt items which are being considered as part of working capital in the annual report, but you feel that it has a debt element to it. And if you are in a position to identify, I have not come across any report wherein any contingent liability outside the books was being identified and it was being shown as a debt. And the point to note out here is that the debt adjustment has a rupee to rupee effect on the valuation. So suppose you identify 100 rupees more debt, so by identifying an additional 100 rupee item of debt, you will be reducing the equity value by 100 rupees as well. That is why it is called as rupee to rupee adjustment. Whereas in case of, say, your adjusted earnings, say you identified an 100 rupees item which was non-recurring, so you added it back, and the multiple, say, is 10. So in that case there would be a multiple effect, that is, the valuation, that is the enterprise valuation, would be increased by 1000, that is 100 into the 10, that is 100 which is non-recurring expense, into the multiple, that is 10. So your enterprise value would be increased by 1000. So yes, any adjustment identified in the earnings section are of high importance compared to the debt part, since multiple plays a crucial role. Third being net working capital as well. So there could be a few adjustments identified in net working capital. Closing capital could be higher than the average capital that is being maintained, and if you think that it is not normal, then that has an adjustment impact as well on the valuation of the company. Basically the same, the BSIS and cash flows are being presented in FDD report as well, but the presentation will be different. So say in an FDD report, say your top line is 100 in 1 year and it has increased to 300 in the second year. In the case of annual report, why it has increased, that won't be mentioned anywhere in the report. Whereas in the case of FDD report, it will be mentioned as in, like, what was the reason for the amount of top line has increased from 100 to 300. The reason could be because of the product mix, the reason could be because of a new introduction of a product line, or the reason could be because you acquired a new company and that revenue got clubbed in the second year. Same for expense side as well, the same for balance sheet side as well. As even there could be general comments on the working capital as well, working capital cycle, as in, like, what is your cash conversion cycle, has it improved compared to the previous year, which could mean that the company is able to generate cash on its own and the working capital is being properly managed. It doesn't need to raise any debt to fund the working capital purposes. So yes, working capital qualitative analysis is being done in FDD report as well, and there could be, it depends on the scope. You could comment on the current trading as well as on the forecast. Just comment, not question the assumptions, but you can just, by looking at the general trend, if you think that the forecast are unachievable or it doesn't look reasonable, you can add a comment to it. And there could be few analysis being done as well, say your top 10 customer analysis and your key suppliers analysis, or by product revenue and price analysis. The reason being, primarily all of these analysis that I'm talking about is linked to the deal metrics section. So say for example, on the basis of the top 10 customer analysis, you come to know that you have lost, say, a customer that is not going to continue in future. So in that case, the revenue that was being earned, or by revenue I mean the EBITDA that was being earned through that customer, will be reduced from your adjusted earnings. since that customer is not going to, so since he's not a repeat customer, and it will have an impact on the valuation part. So yes, there are few analysis being performed as well, and all the analysis are being linked to the deal metrics section. So yes, basically what a live FDD report looks like.